Disney is an entertainment giant. Basically, everyone in the Western world has heard of them. In today's video, we want to evaluate whether or not buying them at today's price could make sense. Let's look at the numbers first. They made a respectable revenue of $94 billion in the last year, with a net income of $12 billion, which means that their profit margin is up quite a bit in the last year to 13%. They're currently selling for $104, which gives them a PE of 16. This might be a bit low for Disney, considering that 16 is around the PE of an average company. So it will be interesting to see if this could be a potential bargain. For that, we will look at two different cases. A bear case first. Next 5 years are for the analysis. Disney's growth is, of course, slowing down. They have to rely on their theme parks to keep on going, on certain movies in any given year to be very popular, and so on. And they're, of course, trying to acquire more and more companies. But for such a large entertainment company, it's just difficult to grow even more. So I think a 2% revenue growth, let's give them around a 3% revenue growth so that they roughly match an average year of inflation in revenue growth. And for a bear case, I would assume that their profit margin go down a bit again, that the streaming services compete more and more with each other, that producing content there costs more and more money. And they are doubling down on buying back shares. So I'm giving them a minus 3% in share dilution. And it's a bit difficult to evaluate Disney here based on that they're selling for 16 currently. And these numbers don't look too good. But I still want to give Disney a little bit benefit of the doubt, considering that they're such a well-established company that I would want them to at least trade for something a bit higher than the average company. So I'm going to give them a PE of 17. And this takes the stock price to around $113 with these assumptions, which would be a meager 1.77% return if bought at today's price. But in contrast, let's look at a bull case, same 5 years, and this time a revenue growth of 5%. You know what, let's increase that to 6%, that they really can get maybe more acquisitions going and so on, that their profit margin stays at the same very high 13.5% compared to their past. And if these numbers come true, I think the stock price will certainly go higher, and therefore the stock becomes more expensive. So buying back shares with the same amount of money will result in less bought back shares. Let's make it around minus 1.5%, around half of it. And these would take the stock price to $203, so looking a bit better already. And bought at today's price, this would mean a 13.25% annualized return. And if we average these two cases out, this would take the stock price to around $158 with an annualized return of 8.73%. So not even quite 9% average annualized return. For these two cases, of course, the numbers might be a bit too low, but I'm currently still a bit on hold for Disney. I bought the shares a long way back, and I would be interested in buying a couple more shares, but I'm definitely going to wait and see if maybe the stock drops down further. But I'm still convinced that this will be a compounding company. They are buying back more shares. They are trying to increase the dividends. So I'm not too doubtful whether or not this company will do good in the future. I just think right now adding more shares doesn't make sense to me. But I might be missing something about this company. So let me know what you guys think down in the comments, and I will see you in the next one. Bye.